So we're here to discuss life insurance in a new and different way. For those of you who are fiduciaries or who serve fiduciaries, for those of you who are trustees of irrevocable life insurance trusts, attorneys, CPAs, CTFAs, RIAs, I can certainly relate to how at least I have found life insurance to be confusing the way it's presented, and that is largely because I came from the same world that you all live in, that fiduciaries live in. I came from the fiduciary world first. I started as a pension investment advisory analyst for a full-service financial planning firm in the mid-1980s. And my job was to take statements, pension and profit-sharing plan statements, that the principals in the firm would come back from meetings with, and my job was to look up the funds in that pension or profit-sharing plan using Morningstar, to look at the expenses, to look at the performance, and to prepare for them a report that they could bring back to the meeting and present for two reasons. One, to help the plan sponsor document their performance of their duties, which we'll talk about, and then also because the plan sponsors were among the largest account balances, they also had the benefit of lower cost and better performance. So I grew up in that world, measuring expenses, measuring performance. As I graduated from school, I sought to diversify my experience and expand my resume, and I went to go work for a life insurance agency. And for those of you who can see the headshot of me here, you know that I'm only half joking when I say I pulled my hair out trying to do what was easy as a 19-year-old in the pension investment analyst business, and it was literally impossible in the life insurance business. And so what I want to do, my goal today is instead of talking about life insurance the way the life insurance industry offers it up, I want to talk about life insurance. I will talk about life insurance in a prudent investor way, in a way that leads to the more prudent, with a capital P, as in prudent investor selection or retention and proper management of life insurance as an asset. What we'll cover today is why people either do or don't incorporate life insurance in their planning. I was surprised early in my career that life insurance was not included in tax planning as often or as little. It was included as little, as infrequently as it was, and why not. We'll talk a little bit about the basics of the products. What are the commonalities? Even though all of these products at times appear just very different, there are great commonalities between the products, and if you understand kind of the framework of the product, the commonalities of the products, then understanding the differences, which are relatively few and far between, become much easier. I want to talk a little bit about the evolution of the industry and how the industry has gone from presenting or producing quotes to illustrations, and why those are different things, and why they can be dangerous, why that change can be dangerous, particularly for fiduciaries. We'll talk about new guidance from a variety of sources in response to this evolution from quotes to illustrations. And I'll wrap up with the best practice standards, the new best practice standards, which is the framework that will allow you to talk about life insurance in very much the same way that you talk about every other asset on clients' balance sheets. And then we'll wrap it up with some questions. You've got some takeaways that I'll talk about, and then we'll wrap it up with questions and answers. So with that, I was surprised that life insurance is not used more often than it was, at least in my interactions early in my career. I'm hanging out at happy hour on Fridays with CPAs, tax attorneys, and trust officers, tax planners, So I would have thought that a product that has 4 unique tax preferences, income tax-free death benefit, tax-deferred cash values, the ability to take withdrawals of your basis on a FIFO accounting basis first, and the ability to borrow gains from cash values and then have those loans repaid by tax-free death benefits. I would have thought that a product that has 4 tax preferences that are unique to this product would be more embraced by the tax planning community. However, as it became apparent to me that it wasn't just, while the tax preferences may have made it appealing, life insurance became and remains the last largest, most neglected asset on clients' balance sheets because it's opaque. Because the things that fiduciaries are used to getting, in fact, the things that they are required to get and routinely get for every other asset on the client's balance sheet, are generally not available, or in some cases simply not available for life insurance. And that leads to clients and advisors having difficulty knowing if they even can find out what they're actually being charged inside these life insurance policies. And as Adam Smith, someone described as the father of modern economics, would say, any product where price discovery is opaque, where it is difficult where there is insufficient pricing information for the invisible hand of the consumer to choose good pricing versus bad, that would be an inefficient market, and the life insurance industry is certainly an inefficient market in this regard, and as a result there are huge price swings between best available rates and terms and worst available rates and terms. Huge price swings, as much as 80%, almost double, for the exact same type of product, for the exact same face amount. The internal charges can be almost double that from one provider to the next. In addition to which, while life insurance is routinely marketed using hypothetical illustrations that project some assumed rate of return, very few clients and very few advisors know what is actually being earned on invested assets and underlying cash values, what is actually being earned inside the policy. So it's no surprise that a policy or a financial instrument, forget a policy, any financial instrument where costs are not known, and so people, when they're being overcharged, they don't know, and performance is not known, so when you're getting underperformance, you don't know. It comes as no surprise that life insurance has been among the worst performing asset types relative to client expectations among all the financial instruments or financial assets on the client's balance sheets. So let's talk about the commonalities. So let's start our understanding with what's common to all life insurance policies. Well, the pricing or performance, the results that the client actually gets out of any life insurance policy is a function of 3 and only 3 things. It is a function of what the insurance company charges for cost of insurance charges to pay the death benefits. It is what the insurance company deducts from the policy for their expenses, their operating overhead, for design, marketing, distribution, underwriting, policy administration, etc., less what is earned inside the policy. So one way to look at this is from the perspective of what the client has to pay. The client has to pay in all life insurance policies, regardless of type. They have to pay enough money to cover the cost of insurance charges and the policy expenses, and that amount that they would have to pay to cover that is reduced by whatever is earned in interest on premiums and cash values in the policy. And the more the interest they actually earn, the less they would have to pay in premium, and the more interest that is assumed to be earned, the less they think they're going to have to pay. But if that assumed interest doesn't materialize, that's when you get a premium call and you get client disappointment. So if there was one and only one thing, actually there's a couple of things that I would encourage you to take away from this webinar, and one of them is this is one of the slides. remember this formula, write this formula down, put it on a corner of your desk somewhere, that every time you are talking about life insurance or every time you get an illustration, that you remember that what you really need to know, particularly if it's not shown to you in the illustration, what you need to ask for is, what are the cost of insurance charges, what are the expenses, and what is the interest? And we'll talk some more about those three components throughout this presentation. As we talk about the different types of life insurance, the different types of life insurance are distinguished. Their defining characteristics are either related to the assets underlying policy cash values, how those cash values are invested, if there are cash values, and the time horizon, the holding period, if you will, for the expected holding period for a given product. So we'll start out with the least risky and the shortest time horizon. That is a product that's not very prevalent in the marketplace anymore. It's called annually renewable term insurance. It's essentially pay-as-you-go life insurance. You pay for 1 year, and then that premium is based on the is based on, it's not literally equal to, but it's based on the likelihood of getting hit by a proverbial bus in that 1 year. And then in the next year, as you get older, the chances of us getting hit by that proverbial bus goes up, and so the premium goes up. And so the premium tracks the probability of death in each year. And so the premium keeps getting higher and higher and higher. The premium also gets higher as the insurance company knows less and less about the insured. So any life insurance policy, every life insurance policy is most cost effective on the date of issue, when the insurance company knows as much as they possibly can know about you. They know you don't have cancer, or they know the client doesn't have cancer, doesn't smoke, is in good health. But as the policy ages, the insurance company knows less and less, and they can't do anything about that. So they build in to their pricing the fact that as we get older, things happen. Some people in the pool for a given policy will have developed cancer, or will have developed heart disease, or high blood pressure, or high cholesterol, and so the price of a policy, as a price of an annually renewable policy, and therefore all other policies, goes up with the holding period of the policy. The second type of term insurance is much more prevalent in the marketplace today. It's fixed duration term insurance, like a 10-year term, or a 20-year term, or a 30-year term. Fixed duration term insurance is always less expensive than annually renewable term insurance, in part because it's as a practical matter, either not renewable or not practically renewable after the initial level period. So the insurance company is issuing insurance for a very finite period of time that is always less than life expectancy. So they know that the chances of paying off on a fixed duration term insurance policy is very small, so they have to collect less to pay those claims. The next type of insurance on our risk and time horizon spectrum is guaranteed universal life. Guaranteed universal life is something of a hybrid. It is a product that has a lot of the characteristics of term insurance. It's got a fixed premium. It has often has little in the way of cash values. But the premium, instead of being set for a fixed duration like 10 or 20 or 30 years, the premium is set by either the client or the advisor, or the client and the advisor working together, and it can be very flexible. It can be a 14-year term policy, or a or a 50-year term policy that actually goes beyond life expectancy, which fixed duration term cannot. It is on and because it's on a universal life chassis, it is flexible and it can be changed. So you can start out with a guaranteed premium for guaranteed death benefit for 14 years, for instance, and then recalculate the premium needed to extend the duration of coverage, and you can have it, and you can extend that from 14 years to some other number just by adding more money. And by the way, the rates at which you get to recalculate that premium and extend are set at the time of issue. So if the client is preferred at the time of issue and 10 years later they want to extend, then you get to extend at preferred rates rather than whatever the health may be of the insured at the time. Moving further out the risk and time horizon, current assumption universal life, also commonly referred to as traditional universal life, is again also flexible. So the premiums are flexible. Death benefits can generally be changed over time. And the current assumption universal life product, instead of the continuation of coverage being based on the payment of a fixed premium that's guaranteed by the insurance company, current assumption universal life works more like that formula we talked about earlier, the CY plus E minus interest percent formula, where you put money in, the insurance company deducts cost of insurance charges and expenses, whatever's left in the account after the deduction of current cost of insurance charges and expenses earns an interest rate, and as long as there's money in that policy account on that basis, as long as there's money in the policy account or coming from premiums that's available to pay whatever the insurance company wants to deduct in that period for cost of insurance charges and expenses, that policy stays in force. The flip side of that is if a client has paid the premium every single year, year in, year out, that they were told to pay, but that premium was calculated using an interest rate that did not come true, as I had mentioned earlier, then they could have paid that premium every single year, but then the cash value runs out and the insurance company says, your policy is getting ready to lapse, as a complete surprise to the client. So it is important, and we'll talk about in the 6-step process, it is really important to monitor and actively manage every product up the risk time horizon spectrum that we're going to talk about from here on in, from universal life on. The next product that has a little more risk and thus arguably should have a somewhat longer time horizon is indexed universal life. Indexed universal life works just like the current assumption universal life, the way I just described, in terms of the coverage lasting for as long as there's money in the account to cover cost of insurance charges and expenses. The difference between indexed universal life and current assumption universal life is in how that interest is calculated. And that can be very complicated, more complicated than we have time to get into here at a beginner's level course. But it is very complicated. It's been subject to change, and so that's one of the things that warrants additional scrutiny, which I will come back to. Moving all the way up to the on the risk spectrum, variable universal life is, again, also universal life, flexible premium, flexible death benefit. Also, the coverage is also, the maintenance of coverage is also dependent upon if there's cash values available from which the insurance company can deduct cost of insurance charges and expenses. The defining difference in variable universal life is that the earnings come from a family of mutual fund-like separate accounts that can be directed. So for the other forms of universal life, the company invests cash values in their general account and pays you an interest rate. With indexed universal life, you get to actually pick what you want the earnings from the company to be used for. They can either be credited to the policy or used to buy options, so you have some some ability to direct there. And with variable universal life, you actually get to pick the underlying assets from a set family of funds. The last type of insurance, which actually, in my view, on the risk time horizon spectrum, falls between current assumption universal life and indexed universal life, is whole life. It has somewhat more risk, currently anyway. Some would argue it has less risk, but in the current environment, it has somewhat more risk than current assumption universal life, because some actuaries say that because whole life has more persistency, because there's less money taken out of whole life than there is universal life, just by nature of the product, that they can invest in longer-term bonds. And if they're able to invest in longer-term bonds, then they get higher interest rates. However, in this low interest rate environment, as these higher interest bonds roll off, they're only able to invest in lower interest rate instruments, and so there's been a precipitous decline in whole life dividend interest crediting rates over the years that has again created disappointment among clients who thought their premium payments were based on a higher interest rate, and that interest rate has been coming down. So to kind of summarize the different product types, the defining difference in each of these products is either the time horizon over which it's covered, or what the interest rate that the client actually gets is based on. What the invested assets, underlying cash values are actually invested in, and what type of direction the client has in choosing what kind of rate of return that they want. Interestingly, I don't know if Stephanie, can you see my cursor on your side?
I cannot.
All right. So if you look at the products, the four products kind of in the middle, from guaranteed universal life to indexed universal life, to include current assumption universal life and whole life, all four of those products are all required by regulation to invest assets underlying cash values in high-grade bonds and government-backed mortgages. Let me say that again. The cash values, or the invested assets underlying the cash values of guaranteed universal life, current assumption universal life, whole life, and indexed universal life are all required by regulation as a practical matter to invest in high-grade bonds and government-backed mortgages. So if they're all required to invest in the same thing, in the same asset classes, then one would think that the rates of return would be at least, the crediting rates would at least be similar. So let's take a look at how these products, how our formula, our cost of insurance charges plus expenses minus interest formula, our foundation, how that actually works in different product situations. By the way, these slides are available for download. I'm not going to go thoroughly through these slides because this is more detailed than I want to get into, or that we have time to get into. But I do want to talk a little bit about this thought framework, this cost of insurance charges plus expenses minus interest thought framework that you see at the top of each of these. We talked about annually renewable term, and there's really, the cost of insurance charges are equal to the premium for annually renewable term, and they're averaged over the level premium term for fixed duration term. There is no, and the expenses are all lumped in, and there is no policy earnings, so that is the easiest product. Those are the easiest products to understand. Where it gets, where the COI plus expenses minus interest framework, thought framework comes into play more, is in the universal life products. Every universal life product has premiums, or excuse me, has cost of insurance charges and expenses set by the actuaries, but the premiums or the coverage duration can be calculated by the by the agent or requested by the advisor or the client. If the product is guaranteed, then the actuaries do that calculation and it's not disclosed. But if it's current assumption universal life, then you usually can get, upon request, almost always get upon request, what am I actually being charged for cost of insurance charges? What am I actually being charged for expenses? And what is the interest rate that I'm supposed to get on this? And then you can compare that to the actual earnings from the general account to see if there might be some gravity or migration back to what the insurance company is actually earning if they're crediting more than that at any point in time. Let me also mention all products have a guaranteed pricing and a non-guaranteed pricing. So I often hear of the debate between guaranteed universal life and whole life, that one has more guarantees or more cash value than the other. All products have guarantees. So it's not that one has it and one doesn't. It's just important to understand the guarantees. The guarantees in a guaranteed universal life policy are actually designed for the consumer. It's designed to look like a term insurance policy. It's designed to have a low premium for guaranteed coverage and little else. A whole life policy has different guarantees, typically a higher premium, higher guaranteed premium, but then there's some other benefits that go with a whole life policy, like cash values or increasing death benefits. And so it is just, for some more reasons we'll talk about in a minute, it is just misleading to try to compare a whole life illustration that's actually a combination of guarantees and non-guarantees with a guaranteed universal life illustration. But they all have guarantees. It's just understanding, are guarantees important? And if they are, then compare the guarantees, the terms of the guarantees. If they're not important, then examine what the insurance company says they're going to charge for cost of insurance charges and expenses, and what the client is likely to receive for interest on the account. Indexed universal life, again, I said earlier, works just like other universal life products, except the interest, looking over at the far right-hand column under policy earnings, here the defining difference is that the cash values are invested in the general account. The general account's invested in high-grade bonds and government-backed mortgages. The high-grade bonds and government-backed mortgages pay interest. The policy owner has the option of having that interest buy options on a particular index, like the S&P 500. The cash values are not invested in equities or in the indexed or in the S&P 500. Only the interest on the bonds and mortgages from the general account is used to buy options on the index. If those options mature in the money, then that can produce a lift on the rate that's actually credited to the policy. And so it's conceivable that a index universal life policy, the interest on an index universal life policy could be higher than the interest that would be credited to a universal life policy, because they're just getting the interest from the general account. The interest from the general account could be turned into more than that by virtue of options on an index. However, if the options expire out of the money, then you get nothing, and you don't even get the interest from the general account, because it was used to buy options that expired out of the money. So it's just important to understand the way and the likelihood of getting the rate of return that's shown in the illustration on index universal life products, because it is different than current assumption universal life products. And then again, variable life products work the same way as other universal life products. Cost of insurance charges are generally disclosed. We're actually going to look at a table later that kind of shows what to look for, but they're generally disclosed. If not in what you're originally given, you almost always can get them available upon request. Same thing with expenses. And then cash values are invested in mutual fund-like separate accounts. But it is, again, important to understand what those accounts are and whether that allocation is consistent with the risk profile of the client as it changes over time. We'll talk about an actual case where cash values went from a universal life policy where cash values are required by regulation to be invested in high-grade bonds and government-backed mortgages, so a fixed income portfolio, a conservative portfolio, and they did an exchange to a variable policy where the cash values were allocated to all 100% equities, including emerging markets and small caps, which is a very aggressive portfolio. And from any perspective of any asset other than life insurance, that would almost never happen. And I think it's just because of the over-reliance on illustrations, which we'll talk more about, and the inattention to what's actually going on what the cash values are actually being invested in and how they could or should be allocated, both for variable life or index universal life, or frankly for consumption universal life, because that really makes that product decision for you. And then lastly, whole life. Again, assets are required to be invested in high-grade bonds and government-backed mortgages, but for whole life, cost of insurance charges and expenses are not generally disclosed. The crediting rate on policy cash values, the expected earnings rate on invested assets underlying cash values is generally disclosed. Sometimes you have to ask for it, but it is generally disclosed, and that is an important thing to ask for. So from a fiduciary's perspective, I spent time on the kind of the foundational formula, or the formula for foundational understanding of how all these products are common and what's different about them. And that's important to understand, particularly from a fiduciary perspective, because probably some on the call, at least my father, when he got into the financial services business, he was given a rate book. And when somebody said, well, what does this whole life policy cost? He'd look in the rate book for the rate, multiply the rate times the face amount, and that was the premium, and generally considered the cost at the time. Since then, in the 1980s, with the advent of universal life, because universal life is flexible, because it's not just one rate. You can pay anything you want, and you can change that payment over time, and so it's not just a single rate for the premium for the life of the policy. It's now a bunch of numbers, and so we got to use computers to model bunches and bunches of numbers. But what that means is that what used to be a quote, a premium quote, what used to be something that was reliable, that you say, what's the premium? You get a number, and it is that number, and it stays that number. Just like if you go to a car dealership and they tell you the car costs $30,000, if it ends up costing $35,000, you walk to the dealership. Well, with life insurance, if you calculate a hypothetical premium using a computer, or use a hypothetical illustration to calculate a premium, and the underlying factors, the cost of insurance charges, the expenses, and the interest don't come true, then that premium ends up being different, but you don't know it in time to walk out of the showroom floor. It doesn't happen until years later, as I alluded to before with the client who may have been paying the premium they were told all their lives, and they get a lapse notice. So in response, because it's important to understand this distinction, we now have guidance new guidance from a variety of sources that are particularly useful to the fiduciary. And so I want to start with the guidance that came from the insurance industry, the National Association of Insurance Commissioners. In 1993, they published a model regulation for illustrations. And the goal of the regulations were to ensure that illustrations do not mislead purchasers and make illustrations more understandable. Last time I gave this, most every time I give this presentation, I get a chuckle here and there about that goal because the experience of those in the audience is antithetical to illustrations being more understandable and less misleading. But even the National Association of Insurance Commissioners updated their guidance, updated their regs a couple of years ago to address lack of uniform practice resulting in illustrations that appeared to use an identical crediting rate, but actually used different crediting rates, if you can even believe that. And that actually, even with these updated regs in 2015, that practice continues today, that you could be looking at an illustration that is that says prominently displays 5 or 6% at the top of the page, but if you actually look at the interest calculated, the hypothetical interest being calculated inside the illustration, which I'll show you in a minute, if you actually look at that hypothetical interest, it's an interest amount that corresponds to a higher rate of return than that prominently displayed at the top of the page, as inexplicable as that may sound. And in fact, I would suggest that the amount of litigation against life insurance companies, agents, brokers, around the use of these illustrations is empirical support that the National Association of Insurance Commissioners model regulation has just failed to date to make illustrations less misleading and more understandable. So if we're not going to use the insurance industry guidance, what other guidance do we use? Well, let's look at a couple of illustrations and then talk about that. So I've got an illustration for every product type, and I'm going to go through it relatively quickly in the interest of time, highlighting on what's common and what's different. So in this whole life illustration, we have a series of guaranteed columns. The premium is $55,000 for a $1 million death benefit. And then we have a series to the right, a series of columns for non-guaranteed values. And in whole life, the non-guaranteed values are a function of the dividend. And the dividend for a life insurance policy is different than the dividend on a stock, on a traditional stock, like a dividend from GE, General Electric, or something like that. The dividend on a life insurance policy is actually a refund of overcharged expenses and a credit of excess interest. So the columns on the left reflect that if you paid $55,000 into the policy and the insurance company deducts the most expenses that they're allowed to deduct and they credit the least amount of interest that they're allowed to credit by contract, then that's what you get in the guaranteed columns. And then the dividend gives you some of that money back. They give you back some of the expenses that they overcollected, and they give you back more interest, the difference between the interest that they actually earned and the interest that they guaranteed. So it is important for understanding the non-guaranteed or the current pricing, the performance based on the charges, the COI charges and the expenses on file with the State Departments of Insurance, and whatever the currently declared interest is. It's important to understand what that currently declared interest is. As I said, sometimes it's disclosed, sometimes it's not. But asking for, if it's not disclosed in the illustration, asking for the dividend interest crediting rate is very important. Once again, this is a product that is required by regulation to invest in high-grade bonds and government-backed mortgages, and there are whole life products in the marketplace that are doing their setting client expectations, are setting expectations for future investment performance at 7%. And I don't know of any data that supports a 7% long-term rate of return from a financial instrument that is required to invest in high-grade bonds and government-backed mortgages that over the long term average 5 or a little more than 5%. So it's very important to get the dividend interest crediting rate if it's not included in the illustration. Sorry, I got ahead of myself a little bit. So moving on to current assumption universal life. Here we see that the interest crediting rate, so on the whole life illustration, the dividend interest crediting rate was not displayed, at least not on the part of the illustration that I was able to show on screen. But here, the interest rate is prominently displayed. It's 3.1%. The premium, the premium that has been calculated as being necessary to cover cost of insurance charges and expenses, assuming that cash values earn 3.1%, is $31,000, $32,000, versus the $51,000 on the whole life policy. So clearly there's got to be something different going on here, because for two $1 million policies where one premium is almost half, well, not quite, but close to half of the premium for the whole life policy, there's got to be something going on. So once again, another example of comparing illustrations. The illustrations are really not a very good tool for comparison, which again we'll talk some more about. Universal life, even the current assumption universal life, has both a guaranteed set of columns and a non-guaranteed set of columns, in the same way that the whole life policy had. So similar, but different in the way the earnings are credited to the policy, and a little different in the nature of the disclosure. So moving on to guaranteed universal life, here again the interest rate is prominently displayed at the top of the screen, or at the top of in the column headings. There, the interest on this particular policy is 4.5%, versus the current assumption universal life was only 3.1%. So if I've got more interest, just thinking about it logically, if I've got more interest being earned in the policy, or at least there's the presumption that there's going to be more interest, then my premium should be lower. Well, the universal life premium was $31,000. The guaranteed premium here is $37,000. That's because guarantees have a cost. If I go ask for a signature or a guarantee from my bank, then they're going to charge me something for that guarantee. And same thing with life insurance. Guarantees have a cost. There are, in some cases, there are offsetting balances that can reduce that cost, but guarantees have a cost. And so even though we have a higher interest rate, that should mean that more interest can cover more of the cost of insurance charges and expenses, and therefore require less premium. Here the premium is a little bit higher because of the cost of the guarantees. Moving on to indexed universal life. Once again, the interest rate is prominently displayed above the column headings. Indexed universal life is one of those products where it is maybe more prevalent, where the interest actually calculated in the illustration is greater than the amount of interest that would correspond to a 6.5% interest rate. So not singling out any particular product, but just it is really important to look at, and I'll show you a page in just a minute, look at the actual interest being credited to the policy and making sure that that seems to be commensurate with the rate of return prominently displayed on the column headings. And so once again, we have a product that has some reason to expect that we could get a higher interest rate. If we're going to get a higher interest rate, then that means we should have more interest dollars to cover more of the cost of insurance charges and expenses. and that would mean less money from the client. And so we have, the current assumption universal life product that invested only in the fixed income, got a lower interest rate, required more money, required $32,000 from the client. This one requires only $29,000 or $30,000 from the client. So that's another example of our foundational understanding formula: cost of insurance charges plus interest, or plus expenses minus interest. And I keep getting ahead of myself a little bit here. So lastly, I'll talk about variable life illustrations. Once again, here we have an 8% net interest rate, and some discussion about the interest disclosures on variable life policies is warranted. While a universal life policy, a current assumption universal life, an indexed universal life, a whole life, and a guaranteed universal life policy, while they all are based on an interest rate, the illustration is based on an interest rate. That interest rate is net of expenses. That interest rate is when the insurance company says you're going to get 5%, it's not 5% and then minus their investment expenses. It's 5% or more in some cases, which is that thing you need to look out for. With variable life invests in mutual fund-like separate accounts, and just like mutual funds, there is an investment expense that's separate from the policy expenses. There's an investment expense in the fund, just like there's a fund management fee in mutual funds. And so with variable life policies, you will often see 2 or 3 different rates of return in the column headings. You'll see the gross rate of return, which is before the deduction of investment expenses, and that is almost unique to life insurance, if not unique to life insurance. Whenever you see rates of return on mutual funds, those rates of return, as reported in Morningstar, the Wall Street Journal, they're almost always net of expenses. So the gross rate of return is, I don't think, very relevant, again, unique to life insurance. So if you're thinking about it relative to rates of return you're familiar with, look at the net rate of return. There can also be a net rate of return. The net rate of return is after the deduction of fund management fees or investment expenses and the deduction of cash value-based insurance expenses, which I'm coming to in the next slide. So there can be 3 different types of rates of return on variable universal life illustrations. The most appropriate way to think about it by my way of thinking is you look at the net rate of return, not the gross, not the net. You looked at the net rate of return, the rate of return after the deduction of investment expenses. So it's just like mutual funds, and it's just like the crediting rates on all other forms of life insurance. And it's before the deduction of cash value-based insurance expenses, which again is just like all other forms of insurance. Because if it's an insurance expense, it's coming out as an expense rather than out of the quote-unquote rate of return. So that's all I'm going to talk about as it relates to the kind of the hypothetical nature of illustrations. Now I want to talk about the most important part of every illustration. I'm showing it here for a variable universal life illustration, but these pages are available for every single product type except whole life. Sometimes you can get the expense figures from actuaries. You can also get them from a company that I founded that publishes pricing and performance research. But you don't need to come to me for these pages on most every form of universal life that shows, as you should be able to see on the screen, it shows the cost of insurance, what the insurance company is deducting for cost of insurance charges, what the insurance company is deducting for expenses, and they collect expenses in the form of either premium loads for state premium taxes, for federal DAC taxes, and for sales loads or commissions. and the expenses that they deduct for fixed administration expenses, and the cash value-based wrap fees. So this column here is the cash value-based insurance expense that's accounted for in the insurance policy, which is again why, by my way of thinking, it makes the most sense when you're trying to understand the rate of return that's reasonable to expect. You look at the net rate of return, in this case the 8% net rate of return, versus the net rate of return on a universal life, or the net rate of return on an index universal life, or the net dividend interest crediting rate, which is the way they're all disclosed, and that makes it apples to apples, at least in terms of what you're looking at. Also be careful that some insurance companies at the head of the page, they show the gross and then they show a net rate, and some insurance companies actually think of the net rate in terms of what I call the net, and other insurance companies think of the net rate in terms of the net rate. So again, just got to be careful about what you're looking at, and understanding what the earnings expectation is, or what the insurance company intends the earnings expectation to be from the illustration. So I've said repeatedly, or alluded to, or said that it's really not a good idea to compare illustrations. We had several illustrations. They all use different rates of return. Even if you ask your trusted agent for everything to be calculated at the same return, we've already talked about how the displayed rate of return may not be the actual rate of return. There are also other differences, like we talked about, between whole life and universal life, that makes it's just inherently different. So comparing illustrations is not very useful, particularly for fiduciaries, but they're certainly useful for other things. And so I don't want to just dismiss them. Illustrations are certainly useful for understanding how a policy could or should work. They're certainly useful for calculating what premium do I need to pay. If you think about it kind of like a pension plan, the actuaries calculate in the pension plan, how much money you need to put into the pension plan to pay out all the benefits. The life insurance policy is similar. The illustration helps you calculate the premium you need to put in order to cover all the cost of insurance charges and expenses that then allow for the payment of benefits. It is also important to save, whenever a policy is placed, save that as issued illustration. That is a very good baseline to measure for future performance. Unless it's a guaranteed universal life policy or a term policy, it will not happen the way it's set forth in that illustration. So having an illustration to measure against, or measure back to in future years, to understanding if we're on track or off track and what adjustments we need to make, is very important. Certainly illustrations are useful to incorporate into financial planning or estate planning, or the cash flow modeling for financial planning or estate planning. And I've seen in books that they say that illustrations are good for comparing costs or performance, and I've already alluded to, and we're going to talk more about, that is simply not the case, and let me explain why, especially for fiduciaries. I know the National Association of Insurance Commissioners is endeavoring to have these illustration regs, model illustration regs, that are intended to make illustrations more understandable and less misleading. But they're really not relevant to fiduciaries. But the model illustration regs are really not relevant to fiduciaries. The guiding principles for fiduciaries are set forth in the Uniform Prudent Investor Act. So let's look at the provisions of the Uniform Prudent Investor Act and see how they may differ from what the model illustration regs call for, or what I call the life insurance industry operating system output is. So trustees or fiduciaries have a duty to exercise reasonable care, skill, and caution. But We now have, I told you I'd come back to some of this new guidance, we now have guidance from the chief regulatory body of the financial services industry, whose mission is to protect the consumer. They have a rule, Rule 2210, that says it is inappropriate to compare a life insurance policy based on hypothetical performance unless you're looking at the things we've already talked about, unless you're actually looking at cost and expenses and the rate of return that's reasonable to expect, which would be the same for the same client. Unless you're looking at those things, if you're just comparing hypotheticals, that practice is misleading. The Society of Actuaries published a study some time ago, actually, even though it has been largely ignored, in part because there hadn't been an alternative or the understanding that we're talking about today. But they published a study that comparing illustrations to determine which policy is more competitive than another is not just inappropriate, but it is fundamentally inappropriate. And most recently, the OCC, so the chief regulatory body of institutional fiduciaries, updated their handbook for unique and hard-to-value assets and concluded that these illustrations are subject to a high degree of fluctuation, and anything that's subject to a high degree of fluctuation is not a very reliable measure of which one is better. So by authority that is useful to fiduciaries, by authority or guidance that is useful to those advisors who put clients' interests first, comparing illustrations, in my view, is dangerous. Alternatively, the prudent process, the Uniform Prudent Investor Act, provides protection. Even if you're wrong, if you follow a prudent process, it provides protection if you do the things that we've talked about. If you look at the costs inside the policy, ask for those detailed expense pages that I showed you, the last page of the illustration section of our presentation here. Ask for those pages, look at the costs. If you're going to compare anything on two different illustrations, compare the costs, not the hypothetical values, and certainly not the hypothetical premium. Look at, so the Prudent Investor Act also includes guidance for looking at the rate of return that is reasonable to expect. All too often, these illustrations show a hypothetical rate of return that is advertised as being back-tested against historical performance, and without examination of what that interest actually is, back to those detailed expense pages, without examining that, you are at risk of not having set reasonable expectations or allowing a client to buy something based on unreasonable expectations. And again, we get back to what is reasonable care, skill, and caution, and that to me is in direct contradiction of the Model Illustration Act. So fiduciaries need to, in my view of the world, fiduciaries need to follow a different mechanism. In fact, in the last 5 or so years, we've seen much more litigation against life insurance companies, life insurance agencies, life insurance agents, and life insurance fiduciaries. And I've read about every one of these cases that I'm prepared to talk about. The Cochran case is probably the best case. I've actually written about the Cochran case in Trust and Estates. It is a perfect example of the differences between what I call the life insurance industry operating system and the prudent investor industry operating system. And in this case, at the end, if we have time, we can talk about it. In this case, the client had as much as $8 million of life insurance and ended up with $2 million of life insurance. And those decisions were supported by the output from the life insurance industry operating system, and that was clearly not in the client's best interest, and arguably not consistent with the fiduciary requirements or the prudent investor industry operating system. Again, we can talk more about that. But all of these cases, the dispute all came about from misunderstandings or misinterpretations or over-reliance on illustrations. either as a primary factor or a supporting factor. The other case that is, to me, very interesting, in addition to the Cochran case, is a case against Goldman Sachs that was adjudicated, I believe, earlier this year. I think it was earlier this year, where a convicted felon, former client of a subsidiary of Goldman Sachs, was awarded $14 million because they bought a bunch of life insurance. They engaged the subsidiary of Goldman Sachs for advice, but the advisor didn't follow the prudent investor rules, the prudent investor principles that we're talking about today. The advisor did what the life insurance industry has to offer. They ran a bunch of illustrations, and from a life insurance industry perspective, they did a very good job. They ran a lot of illustrations. I know the experts on both sides of this case. They ran a lot of illustrations, but Mr. Nazio, who was disgruntled with Goldman Sachs, as it turns out, because of the relationship that led to his conviction as a felon, he was able to use his life insurance portfolio as his way to get a pound of flesh for him being disgruntled with Goldman Sachs, because he hired another insurance advisor who ran a bunch more illustrations, and because neither side could tie their advice to prudent investor principles to the law, the judge had to make a decision based on just which attorney either made the most compelling argument or had sorry, it was a jury trial, or the jury picked the party that they felt most sorry for, instead of what the law actually provides. So that's a very interesting case. That's also an article that if anybody's interested, I don't know if that's part of the handouts or not, but I'm happy to share. So if we've got an output, these illustrations are the output or at least the principal output from the life insurance industry operating system. And if that's not supporting fiduciary duties and fiduciary decision making in clients' best interest, then what do we use? Well, in 2011, the Financial Planning Association, which is an organization of advisors who are fiduciaries, they looked around and said, look, our members are fiduciaries. We have support for fiduciary advice on investments, but we don't really have any support for fiduciary advice on life insurance. So they took an established decision-making framework, common in the investment business. They convened a task force, which eventually grew to 17 participants who all met at West Point to vet this decision-making framework, this established decision-making framework, but as it applies to life insurance. And that group of 17 was comprised of representatives from most every profession who has clients who has life insurance. One of the largest trust and estates firms was there. So from the legal or the planning perspective, one of the largest third-party administrators of trust-owned life insurance. So the institutional fiduciaries perspective, the largest association of CFPs, the FPA was certainly there, and CFPs are among the largest fiduciary financial planners, along with PFPs for the AICPA. We got the academic perspective from the leading university that certifies CFPs straight out of college, and we had 6 of the largest independent distributors there. So at virtually every profession who has clients who have life insurance, who often come at this at product recommendations from different perspectives, sometimes diametrically opposed perspectives, all got in a room and vetted a 6-step process that has 17 dimensions to apply to life insurance, the same universal decision-making framework that's widely accepted in the investment business. And so for those, if anybody on the phone is a CFP or an AIF, an accredited investment fiduciary, this framework may be very familiar to you. For the attorneys and CPAs and trust officers on the call, not necessarily, certainly not trying to teach you how to be a life insurance advisor, but instead this is a valuable checklist for what to look for in fiduciary-oriented advisors. 6 steps and 17 dimensions. Again, time does not permit me to go deep into each of these steps, so I'm just going to talk about, I'm going to hit the high points of each. Step 1 is define roles, responsibilities, and it's a good time to address conflicts of interest of the parties right up front. And I analogize the life insurance industry of today to my early days that I referenced in my early remarks. My early days as a pension investment analyst in the pension investment advisory business. Back in the mid-1980s, there were lots of conflicts in the mutual fund business. There were more loaded funds than no-load funds. There were just more conflicts. Now there's a lot more no-load funds, and it's more of a compensation, more of a wrap fee than it is a sales load or transaction-based compensation. So it's not that the life insurance industry is bad. It's just that it hasn't evolved as much as the rest of the financial services industry, and there are conflicts, lots of conflicts. Some would say that you can resolve the conflicts by doing the same thing that the mutual fund industry has largely done, not completely done, but largely done, and that's go to a no-load product. I would submit that that's not a reconciliation of all conflicts, because the goal of a fiduciary is to serve the goal of any advisor or any advisor that's actually advising is to serve the client's best interest. And so that would mean the search for best available rates and terms. Well, there are about 3 life insurance companies that manufacture no-load products. Again, back to my analogy to the mutual fund business, where there was more mutual funds with loads than without. There is just a minority of insurance companies that manufacture no-load products. And so if your goal is to search for best available rates and terms, then your chances of finding them, for reasons we'll discuss more, but your chances of finding them in 3 providers of the at least dozens, if not hundreds, of insurance companies is very slim. So limiting your product selection by compensation model is also a conflict. So just talk about conflicts up front, who's got them, what are they, and then move on to step 2, where we want to analyze the client's situation, analyze the client's goals and objectives in a manner that more naturally leads to prudent product selection. And by that I mean that in step 3, we want to strategize what are the characteristics of the product that meets the client's goals and objectives. So 2 and 3 are very closely related. In 2, we would have defined what's the client's risk tolerance, and then in 3, we match up what are the assets and asset class preferences that correspond to that risk tolerance. In step 2, we would have analyzed the client's time horizon for the element of their planning that this life insurance addresses. And then in step 2, we would have analyzed or checked in with them about their expected outcomes. And then in step 3, we would have strategized what's the historical performance of the invested assets of the asset classes, so that we can reconcile what the client expects with what historical data is, and come up with a rate. It's a good acronym because we discussed earlier that the rate of return that is reasonable to expect from each product type is most reasonably determined by what they're invested in, what their options are, and it's the defining characteristic, as we said earlier on the time horizon risk spectrum. It's the defining characteristic of the different product types. So understanding the rate of return understanding the risk tolerance, the asset corresponding asset classes, the time horizon, and the expected outcomes. Understanding the rate of return is essential to product selection. For instance, taking an example. This is not intended to be precise, but using some round numbers from some investment research, a conservative risk profile would typically be invested 20% in equities and 80% in bonds, and the rate of return that is reasonable to expect based on historical data is 5-ish%, maybe a little bit lower than that given the low interest rate environment that we're in. But just as a guide, if you're looking at if you have a client who's conservative, then you probably should be looking at guaranteed universal life or whole life or universal life, and you should be looking at and asking for illustrations that show a 5 or so % rate of return, even if the insurance company says that they're currently declaring with the right to change it at any time, currently declaring a rate that's higher than that. On the other side of the spectrum, if you had a very aggressive a client with a very aggressive investor temperament, it's conceivable that policy could be allocated 100% to equities. You would have to go to a VUL chassis for any product. Any client that would have a investor temperament or a risk profile where equities would be part of the allocation, moderate, aggressive, or aggressive, you'd need to go to a VUL chassis. The only exception to that is because you have the possibility of some equity participation in indexed UL by virtue of the options on an equity index, that one could be used for a moderate conservative investor temperament. So we start with define clients, define roles, responsibilities, and conflicts. 2 is analyze goals and objectives in a way that most naturally lead to product selection. We strategize the 4 things that determine product selection, as summarized in the table below. And then we move on to step 4, formalize the solution. So now we're coming down to where we've chosen the type of product that's appropriate for the client, and now we want to see where do we go to find to find best available rates and terms. Once again, the insurance industry of today is not unlike the investment business of decades ago. There are a number of constraints. I remember when I was trying to use Morningstar to produce those reports for the partners in the firm to go back to clients with an analysis of expenses and performance. Only about half of all mutual funds were in Morningstar. So there was a information constraint. There was a debate back then, as remains today, about no load versus load. There were also American Funds was the largest distributor of mutual funds, but they only distributed their funds. So there were distribution channel constraints. Proprietary products, there are then and now, there are marketers of proprietary products where because they're proprietary, they're obviously better in the eyes of the proprietary provider, but they might be that view might be skewed by either additional compensation or the fact that they're co-manufacturers or what have you. And so you want to look for what are the constraints, try to break down as many of the constraints. Certainly don't be constrained by prevailing marketing practices of comparing illustrations. Look for advisors that get down into the support of fiduciary duties if you're a fiduciary. Get down into the expenses and the actual expenses and the actual historical performance. And so we started with defining roles, responsibilities, and conflicts. We analyzed the client situation in a way that leads to product selection. We identified the product type, we strategized the product type, formalized the way we're going to go about actually searching for best available rates and terms, and then we actually, once you've engaged a team member to search for best available rates and terms, or discuss with your team member the search for best available rates and terms, start with a due diligence criteria that satisfies the goals and objectives defined in step 2. The company that I founded publishes research on the 5 major considerations when in a decision-making process for either the selection or retention of any life insurance policy. It's the same 5 things most people talk about whenever they're buying or considering life insurance or considering keeping life insurance. What's the strength of the company? What's the cost? Which more often than not, they're actually looking at a hypothetical premium when they think they're getting the answer to cost. We'll talk more about that. How stable is the pricing? There have been a number of lawsuits and several going on right now that what the clients thought they were going to pay in premiums is not what actually needed to be paid in premiums. And so how stable is that pricing? How liquid are policy cash values? Is that important? Can I have access to my cash values? If not, how long do I have restrictions? And the one that is most inexplicable to me is what is the actual historical performance of invested assets underlying cash values? That is the way investment decisions are routinely made for every other asset other than life insurance. Past performance is no guarantee of future results, but it is certainly a accepted measure for what is reasonable to expect. And the rates of return shown in hypothetical illustrations oftentimes are in no way, shape, or form correlated with actual historical performance. So ask the question about actual historical performance. I said I'd come back to costs. We talked about very early on that there is as much as an 80% swing between good and bad pricing. So if you know where the average is, which we know because we have the database of more cost of insurance charges, admin fees, wrap fees, and premium loads than anybody, so we can calculate a representative average, in the same way that the S&P 500 is not the arithmetic average of stock market performance. It is a representative, a very meaningful representative average of stock market performance. We have a representative average of cost of insurance charges, expenses, and loads. And so we can calculate the average, we can calculate the standard deviation, and we know where most of the worst rates and terms are. We know where most of the, or at least the boundary of the best rates and terms are. And so in a matter of a lot less time than it would take to get a bunch of illustrations and compare hundreds and hundreds of numbers on one page to hundreds and hundreds of numbers on another page, which only gives you the answer between 2 or some small number of products, in a lot less time, the Veralytic database can reveal whether a product is among best available rates and terms among the entire universe of peer group alternatives or involves some excessive charging. And then lastly, I've referenced, I haven't talked a lot about, I do in other settings, but I talk a lot about, and I've written about, the life insurance industry operating system versus the prudent investor industry operating system. And they're just different. And one of the differences is that I don't think the life insurance industry operating system even has a monitoring module. If you think about operating systems and modules of the operating system, it is implicit in the best practice standards. It's, step 6 is look at periodically produce reports that go back and look at the things that we looked at in steps 1 to 5 previously. So kind of wrapping it all up, life insurance is increasingly being considered or promoted as an asset, and arguably is an asset. I take no issue with the assertion that life insurance is an uncorrelated asset. It is absolutely an asset on the client's balance sheet. It's the last, largest, and most neglected asset on the client's balance sheet, and almost universally the worst performing asset on the client's balance sheet relative to their expectations. So it's time for a new conversation. In my view, it's time for a new conversation about life insurance, a new way to think about life insurance, a new way that is supported by guidance from industry authorities that avoids the misleading, inappropriate, and unreliable illustration comparisons that is the principal output from the life insurance industry operating system, and instead embraces either if you're an advisor that is that supports fiduciaries or that is trying to provide support for fiduciaries who have clients who have life insurance, then embrace the best practices as an operating system. If you're a CPA, tax attorney, or a trust officer, and you're not in the business of actually managing life insurance, not actually making decisions about the prudent selection and proper management, but you want to make sure you're working with somebody who has a value system and an operating system and interest aligned with yours, then use the best practice standards as a checklist for your conversations with insurance advisors that you work with. The best practice standards should be included in what you're available to download. If not, in a minute you'll see ways that you can contact me. The Trust and Estates article I mentioned, I'm very proud of. It was an earlier version of it published in Steve Lineberg's estate planning newsletter, which many of you may subscribe to. Steve described it as a must-read case. And so the Trust and Estates article I'm very proud of as a narrative that talks about the case in the way we've talked about it today, in the differences between the life insurance industry operating system and the prudent investor industry operating system, the new and better way to talk about life insurance. I also write a monthly column for Investment News, and also wrote about the Goldman Sachs case there. Again, if it's not in the materials, then you're more than welcome to contact me. For those who are Lineberg Information Services subscribers, you may have already seen the 6 essential ingredients to life insurance advice. That piece, I think, is included in what's available for download. That also includes a number of flow charts, decision trees that support the best practice standards as a decision-making framework. I would encourage you to download that. And then anybody who's interested in understanding more about how Veralytic measures expenses against the universe of peer group alternatives, measures performance, actual historical performance against peer group alternatives, I'm happy to provide anybody with a complimentary report. We have a number of patents. The benefit of a patent is the government grants me a monopoly for a number of years. The curse of a patent is nobody knows how it works, so I'm happy to let you take it for a test drive on my dime. Each report includes an executive summary that explains the star rating, why it's rated 5 stars or 4 stars or 3 stars or 2 stars or 1 star. It includes the analysis page, an excerpt of which for the policy expense breakdown we saw earlier in step 5 of the best practice standards. And then if you want more information from me or any of these handouts, follow me on LinkedIn. I post everything I write on LinkedIn. Follow me on Twitter. I post announcements of their availability when they're published in various publications. You're welcome to email me directly, or you can go to the Veralytic website and look and snoop around for yourself and download a report there for yourself. It won't be as meaningful as the complimentary report because it is for a circumstance that you don't have any familiarity with, and the best way to learn about how Veralytic might help you with your in your practice or with the prudent selection and proper management of life insurance is to get a report for an actual policy of your choosing for circumstances you're familiar with.